Let's take a look at the fixed income space now, particularly the bond market. Jim Stening joins us from Fixed Securities. Jim, good to have you on board because there's growing chatter about a bubble in bond markets at the moment. Do you think that the rally that we've seen has been on anything fundamental?
Well, I guess, fundamentally there's a lot of demand. I think, obviously the buying is real in the face of the headwinds, I suppose, of Chinese reduction of their holdings and also this ongoing fire hydrant of issuance. So the fact that yields have fallen considerably, that does demonstrate there's a hell of a lot of demand. But in the scheme of things and where we are in the cycle, what seems to be happening here is that investors are, in allocating to fixed income at these low levels, particularly long duration, are sort of painting themselves into this corner where, a double dip or prolonged downturn or recession has to play out for that to be a sensible thing to do in the long term.
By long term, you're talking 10-year note and higher.
Yeah, look, I think long-term I'm talking 3 to 10 years. Right. I think, where we are in the cycle at the moment, these rates could move lower. But I think if you take a step back and you look at where inflation has to average over the term of that bond for that to be a sensible investment decision, things need to, inflation does need to be very low to justify that.
So would you call what's happening a bubble, though? Is that what you actually think?
Look, I think what we saw in the early 90s after that recession was a massive sell-off in government debt, particularly in this country, and it resulted in huge capital losses in fixed duration bonds. And I can see something of that ilk developing in the US, particularly when you look at these structural budget problems that they have. It's luxuriating in this flight to quality at the moment from domestic investors. There's been lots of problems in the US with the banks, the regional banks, with the municipal bond market, and so domestically investors like the pension funds and individuals are seeking safe haven in the treasuries.
Bill Gross from PIMCO saying, look, the Fed's trying to reflate the economy, targeting an inflation rate of about 3%. Now, if he's right, what will that mean for the appetite for these shorter dated?
Well, I guess, look, that's my point. I think that, where the rates are at the moment, where the benchmark rates are at the moment, they're implying deflation. That may be a probability, but arguably not as high as a recovery. So underlying inflation rates at 3%, that would not be very good for bondholders who've invested at 2.5 to 3%, because arguably yields would be, 4.5 to 5.
If that market's at risk of being in a bubble, or some people are saying it is in a bubble, certainly. What about the flow through to the local bond market? Have you seen much of that, and is there any risk here as well? Well,
what we're seeing here is just ongoing demand for longer dated Australian sovereign debt. We've punched through the 5% barrier, which in the scheme of things is, that's a fairly significant, given we have a cash rate of around 4.5%. It's intimating that nothing much is going to happen for a long period of time. We've also had some positive domestic data. We had the wages data yesterday. We've had recent sort of softening in employment. Inflation seems to be in check for the time being. So I suppose there's a bit of weight of demand at the moment.
What do you think the demand will be for this coalition policy that came out very belatedly yesterday to talk about an infrastructure plan involving issuance of bonds? People say this has got strains of what happened in was it the 80s or the 90s with Hawke and bonds, and if anything, though, a wild misuse of that for, in order for tax deductibility reasons. These were bought and on-sold, and they were misused.
Yeah, look, I think what tends to happen with tax-effective fixed income is that the tax benefit in the secondary market is completely removed or arbitraged out. I mean, we're very supportive of the development of a bond market, as you know, but I think that what's fundamental to the evolution of that type of issuance is there's a lot of hard work to be done in the background building the infrastructure around a market, a functioning market. It's a bit like saying how to play the flute. You blow in one end and move your fingers up and down. It doesn't necessarily make a good sound.
But it seems as if a lot of the strategists are saying this is still a state issue infrastructure. This is not even a federal one. So long as that's not addressed, why would the leaders in Canberra be talking about federal infrastructure bonds? How would it mesh with states not agreeing?
Yeah, well, look, I guess it's an option for states as well. I think it's a good development that people are talking about these things. But in the back of my mind, I can't help but think that governments are probably in the best place to fund infrastructure development, particularly in the early stages, and particularly when their cost of funds are so low.
Would you see much demand from retail investors for
Well,
that 30%?
one thing I'm pretty sure will you know, be a sort of increased demand is tax effectiveness. I mean, people are very and obviously high.
Yeah, but the government can't afford that. That's the problem. They made that mistake the last time round. They had to pull the plug on the plan because it was costing them too much in the way of revenue. Everyone was claiming tax deductibility.
Yeah, look, that's right. I mean, that's an issue. But I mean, from a retail investor's perspective, that does work. That's something that they like to see.
I'm just saying, at this point in time, can we afford that trade-off? Can we afford not?
You know, like I said, I mean, I think, you know, if you're looking at funding infrastructure projects that are obviously highly geared, have a lot of debt, the cheaper the cost of funds, the better for the higher probability of success of the project.
Right.
So, you know, I mean, that's what you know. If tax effectiveness can mean a reduction of funds in the private sector for those players, that's great.
You'd think it would involve some sort of cultural change for Australians, though, to be
no
in
question.
a very bit interested, though.
Yeah, look, I think, you know, in order to get retail investors in particular to consider bonds, I mean, arguably there needs to be some sort of a directive, or it needs to be an asset allocation prescription for super funds, or the tax benefit is a big carrot.
Good stuff. Thank you so much, Jim. We could chat for longer, but that's it for today. Thanks, Jim. Jim Stening there from Fix.